standing in an emergency room, right? And you're just staring at an EKG monitor.
Okay, I'm picturing it.
The patient's heart rate is just wildly erratic. Alarms are blaring. The room is in complete, utter chaos. But the attending physician just looks at you, shrugs, and goes, "Looks perfectly healthy to me."
That is quite the visual to start with.
Well, I mean, that profound, almost absurd disconnect between a chaotic reality and just total unbothered calm, that is exactly what we witnessed in U.S. equities today. Welcome to Market Recap. I'm Daniel.
And I'm Mira. So glad you are joining us today.
Today is Monday, April 27, 2026. And for today's deep dive, our mission is to basically untangle this massive, glaring market paradox.
Yeah, we really need to figure out the exact mechanics of how the stock market managed this resilient V-shaped rebound today, especially despite a weekend that was just overflowing with severe geopolitical breakdowns and, frankly, unprecedented domestic security shocks.
I mean, it defies basic financial gravity.
It really does. But before we unpack the how and the why behind that market reaction, I do need to explicitly state that this deep dive is strictly for market context and discussion.
Right. Always important to note.
Exactly. We are analyzing the mechanics of the market for you, but this is not personal investment advice or an investment recommendation.
Good. And we should probably also add a note about the nature of today's news.
Yeah, absolutely. We are going to be discussing some highly sensitive political and geopolitical events today, so we want to be crystal clear that we do not endorse any political viewpoints. We are impartially conveying the facts exactly as they appear in the original source material.
Perfect. So with that established, let's jump right into session one. What set the stage before the U.S. session?
Yeah, we have to rewind the clock back to Friday afternoon to truly grasp the scale of the risk the market just completely ignored today.
Because the narrative going into this morning was entirely shaped by what looked like a total collapse of global stability. The dominoes really started falling late Friday.
They did. At 4:56 p.m. Eastern Time on Friday, news crossed the wires that the Pakistan-brokered ceasefire talks between the U.S. and Iran had completely collapsed in Islamabad.
And, I mean, this wasn't just a minor diplomatic hiccup, right?
No, not at all. The Iranian delegation effectively walked away from the table. They refused to entertain any concessions.
And the response from Washington was immediate and highly public.
Yeah. President Trump abruptly canceled the planned trips for U.S. envoys Steve Witkoff and Jared Kushner, and he took to social media to dismiss an Iranian counteroffer as a, quote, worthless document.
Which, fundamentally alters the timeline for resolving these naval blockades. The moment those talks died, Iranian Foreign Minister Abbas Araqi just shifted his itinerary completely.
Right. He headed off to Oman and Russia instead of continuing the dialogue.
So heading into the weekend, the primary mechanism for unblocking the Strait of Hormuz basically vanished.
Yeah.
But the risk multiplier didn't stop at the border.
Oh, definitely not. We had a staggering domestic security shock on Saturday night. The magnitude of this event really cannot be overstated.
Yeah, at 8:35 p.m. Eastern Time on Saturday, an armed suspect fired a shotgun outside the White House Correspondents' Dinner in Washington.
It forced the immediate emergency evacuation of President Trump, the First Lady, and top cabinet officials from the venue.
Now, the suspect was quickly apprehended, and the president was entirely unharmed. But Mira, if you are managing institutional risk, this is huge, right?
Oh, it's massive. A sudden threat to the physical continuity of government is the exact kind of tail risk event that historically triggers aggressive short-term panic selling in equities.
Yeah, you usually see an immediate flight to safety in treasuries and gold the second the opening bell rings.
Exactly. And then you couple that domestic instability with the physical conflict expanding in the Middle East. Over the weekend, Israel significantly escalated its strikes against Hezbollah in Lebanon.
Right. Prime Minister Netanyahu instructed the military to forcefully attack Hezbollah targets. They were leveling buildings in Qiyam and issuing formal military evacuation warnings for, I think, 7 towns north of the Litani River.
Yeah, 7 towns. And just to ensure global energy markets felt the absolute maximum amount of pressure over the weekend, the U.S. Treasury effectively clamped down on global oil flows.
Oh, right. The waivers. This was Friday evening, right?
Yes. On Friday at 6:12 p.m. Eastern Time, Treasury Secretary Scott Bessent officially ruled out extending oil sanction waivers.
So they are not renewing waivers for Russian oil shipments at sea, and they outright killed the one-time waiver for Iranian oil.
And Daniel, the mechanism of that decision is critical for you to understand as an investor. When you pull those waivers, you aren't just making a political statement.
Right, it's highly operational.
Exactly. You are legally forcing global buyers, specifically those using the U.S. financial system to clear transactions, to immediately halt purchases of Russian and Iranian crude.
Which means you are taking millions of barrels of physical supply off the global market basically overnight.
Yeah, forcing buyers to scramble for replacement barrels, which is the literal textbook catalyst for a sudden spike in sticky headline inflation.
Okay, so this is where I really have to push back hard on what the market did today.
Let's hear it.
I look at this weekend news flow, right? Diplomacy, dead. An armed attack, you're the U.S. cabinet. Regional war expanding. And physical oil supply, deliberately constricted.
It's a lot.
It's a ton. And the market just shrugs it off. I mean, are institutional investors just treating all of this as geopolitical brinkmanship, as bargaining leverage?
That does seem to be the prevailing attitude.
Because it feels like Wall Street algorithms are just dangerously complacent right now. Like, you can play games with bond yields, but you cannot bluff your way out of a physically blocked shipping lane.
Your skepticism is completely warranted here. The setup was a perfect storm for a violent Monday morning sell-off. And yet
we survived it. So that perfectly sets the stage. Let's take a quick breather, and when we come back, we will dive into why the market decided to ignore all of those red flags.
Sounds good.
All right, welcome back to our deep dive. Let's get right into session 2. Mara, what moved markets during U.S. trading hours today?
Well, the price action we saw today paints a completely different picture of how modern capital is digesting these overlapping crises.
Yeah, let's look at the actual tape from today.
Yeah.
Because the S&P 500 opened, experienced some initial chop, but ultimately it just stayed range-bound throughout the day.
It really didn't just survive. It closed near its absolute highs at $7,173.91.
Which is wild. We didn't see a systemic dash for the exits at all. The VIX, the market's premier fear gauge, it actually dropped down to 18.02.
The equities market basically decided to look straight through the geopolitical noise. But Daniel, if you look at the physical commodities market, the stress was highly visible.
Oh yeah, that's where realities seem to anchor the pricing today. Crude oil futures, the CL equals F ticker, surged to a massive intraday high of $97.67.
Wow.
Yeah, before finally settling back a bit to $96.72. And gold, which is the ultimate geopolitical hedge, saw violent price swings all day before closing at $4,694.80.
Meanwhile, the U.S. dollar index slid down to 98.48. So the physical materials are pricing in severe disruption. But the stock market is just kind of floating above the fray.
Floating's a good word for it. So what's the why here? Why the equity resilience?
To understand that, we have to look at a crucial piece of news that dropped while most of the U.S. was actually asleep. Late Sunday night, at exactly 9:01 p.m. Eastern Time, reports surfaced that Iran had formally proposed a new framework to the United States.
Oh, right, the conditional de-escalation offer.
Exactly. Iran proposed reopening the Strait of Hormuz and lifting the naval blockades, but only in exchange for postponing the broader nuclear talks indefinitely.
Now, the operational reality of that proposal is highly complex, especially since, as of Monday afternoon, the White House explicitly stated they were not actively considering this proposal yet.
Right. Furthermore, we know that President Trump convened a national security meeting at 8:40 a.m. Eastern Time this morning, where they actively weighed whether to bypass negotiations entirely.
Yeah, they were looking at just resuming a U.S. bombing campaign, so it's not like tensions are actually cooling.
No, but the market isn't waiting for a signed treaty. For the algorithms and the institutional buyers, that Sunday night headline provided a viable path to de-escalation.
It gave them the excuse they needed to keep buying, basically.
Sure.
But treating these events like a weather pattern, just hoping the geopolitical storm passes, it seems incredibly short-sighted to me.
It is short-sighted, absolutely. And it relies on a fundamental misunderstanding of statecraft.
What do you mean?
Well, there is this terrible reflex in financial media to view Middle Eastern conflicts as unpredictable, irrational spasms of violence. But if we step back and apply a game-theoretic lens to this, Iran is playing an incredibly calculated, rational hand.
Okay, walk me through that.
They understand that choking the Strait of Hormuz is their single greatest point of leverage. But they aren't just sitting in the dark waiting for a U.S. response. Behind the scenes, they are actively shifting their physical oil exports north via the Caspian Sea.
Right. And utilizing rail networks to maintain their supply lines to China.
Exactly. So they are actively building a back door to circumvent the U.S. blockade while holding the front door closed to everyone else.
Man. And they are backing that physical supply chain pivot with some really heavy geopolitical maneuvering.
Precisely. When Foreign Minister Araki left Islamabad, he traveled straight to Russia and met directly with Vladimir Putin today to coordinate their resistance to Western sanctions.
So Iran is engineering ways to survive the pressure, while the U.S. Treasury applies maximum economic strangulation. Both are highly rational actors manufacturing leverage.
Exactly. But while that high-stakes poker game is happening on the global stage, we also have to examine the macroeconomic plumbing that kept the floor under the U.S. market today.
Because hope for diplomacy doesn't pay dividends, right?
Yeah.
What actually pays the bills is liquidity. And today, discount rates as gravity on valuations remained incredibly stable despite all the chaos.
The Treasury options today were really the unsung heroes of the market's resilience.
Yeah. The U.S. Treasury came to the market needing to offload a massive amount of debt. If investors were truly panicking about inflation and oil shocks, they would have demanded a massive premium to buy those bonds.
But they didn't. Instead, the 2-year note auction saw robust demand, clearing with a yield of 3.815%.
And the 5-year note auction followed suit with equally solid demand, yielding 3.955%. When the bond market calmly absorbs that much new supply without throwing a tantrum, it keeps the cost of capital predictable for corporate America.
And we had a fascinating cyclical counterbalance coming out of Asia overnight, too, that gave multinational companies a reason to breathe a sigh of relief.
Oh, the China data. Yeah, they effectively threw a lifeline to the global growth narrative.
They reported that industrial profits jumped a massive 15.5% year over year in the January to March period.
And to compound that optimism, Moody's officially upgraded China's sovereign credit outlook from negative to stable.
Which is huge. I mean, if you are an executive at a massive industrial conglomerate, the Middle East supply chain looks terrifying today, but your massive end market in China is suddenly showing concrete signs of stabilization and growth.
So the foundation of today's market was basically built on stable bond yields, Chinese industrial recovery, and the faint hope of an Iranian diplomatic off-ramp.
Yep, that's the macro summary right there.
Awesome. Let's take another quick pause. And when we return, we will look at the corporate engine that is actually driving the S&P 500 through this minefield.
Be right back.
Moving into session 3, let's dig into the corporate side of things. Mira, what was the corporate events recap and what should we watch next?
Well, if you really want to know the engine driving the market right now, you have to look at the tech backstop.
Right. We are essentially watching AI CapEx as an existential arms race, and the sheer volume of capital flowing into that sector is just drowning out the macro noise.
It really is. And we got a foundational update on the economics of that arms race right at the opening bell today.
The Microsoft news.
Yes. This morning, at 9:02 a.m. Eastern Time, Microsoft announced a massive structural overhaul of its partnership with OpenAI. And this isn't just a personnel shift, it fundamentally alters the profit mechanism of the entire AI boom.
Yeah, Microsoft announced they will no longer pay a revenue share to OpenAI.
Which is a huge shift.
Huge. I mean, they get to retain their intellectual property license to the technology all the way until 2032. But dropping that revenue share completely changes the math for Microsoft's cloud margins.
To understand why the market loves this, you just have to look at the unit economics. Previously, a slice of the top-line revenue generated by these AI cloud services was bleeding out to the partner.
Right, going straight back to OpenAI.
Exactly. By securing the IP license but cutting the revenue share, Microsoft captures the full profit margin as this technology scales globally. It transitions them from heavily subsidizing research to ruthlessly monetizing the deployment.
Meanwhile, OpenAI is now free to serve its products across other cloud providers, which kind of blows the ecosystem wide open.
Yeah, the ripple effects there will be interesting.
And it wasn't just the traditional big tech players making moves today either. We saw the legacy telecom sector aggressively entering the AI infrastructure arena.
Oh, the Verizon announcement. Yeah, at 7:02 a.m. Eastern Time. Verizon announced they're in deep, active discussions with major hyperscalers.
Right. They're looking to integrate their vast 5G networks and physical fiber optic assets directly into the AI infrastructure build-out.
And the market rewarded them instantly, sending Verizon stock up 4%.
It just proves that the capital expenditure isn't staying contained to just buying graphics processing units anymore. The spending is actively spilling over into the hard utility and telecom infrastructure required to move all that data.
But, the tech sector's expansion into global infrastructure isn't without serious cultural friction.
That is very true. We saw that friction boil over at Alphabet today.
We did. At 11:07 a.m. Eastern Time, reports surfaced detailing significant employee backlash inside Google.
Right, because the Pentagon recently integrated Google's Gemini models into its GenAI.mil platform for defense personnel.
Yes. And Google engineers are now actively urging the executive team to block military applications of their AI.
Which highlights a fascinating execution risk. If you think about it, these defense contracts are incredibly lucrative, offering massive, guaranteed revenue streams.
Totally guaranteed money.
But if your highly specialized engineering talent revolts on moral grounds, it becomes a major bottleneck for product development. Like, you can have all the compute power in the world, but you still need the engineers to build the models.
That's a great point. And that tension in the tech sector brings us to a crucial piece of data that dropped right as the market was logging off for the weekend.
Yeah.
It's a data point that directly challenges the invincibility of this AI rally.
You're talking about the 13F filing late Friday.
Yes. At 4:34 p.m. Eastern Time on Friday, a mandatory filing disclosed a massive bearish bet from Michael Burry, the investor famous for predicting the 2008 housing crash.
Right. The big short guy. What did he do?
He is currently holding a $47.4 million put position against the iShares semiconductor ETF known as the SOX.
Wow. A nearly $50 million bet against the very silicon that powers the entire AI revolution.
Exactly. That is a highly convicted contrarian play against the strongest engine in the market.
It really forces you to ask, is the AI boom as selective winner-take-most narrative starting to crack under the weight of its own astronomical valuations?
It really does.
I mean, are we reaching a point where the expectations for chip makers are simply too high to sustain?
That is the defining question for equities moving forward, especially when a handful of semiconductor companies are carrying so much of the index's total performance.
Yeah, we'll have to keep a very close eye on those semiconductor flows. But before we get to tomorrow's economic calendar,
Oh, I know what you were going to say.
I just want to take a brief moment to appreciate the true heroes of today's market action.
Let's hear it.
The 2,000 commercial ships currently stranded outside the Strait of Hormuz.
Yeah, what a nightmare for them.
Right. I mean, while Wall Street algorithms are processing millions of calculations per second to push the NASDAQ higher, these captains are just playing the world's most extensive waiting game.
It's unbelievable.
At this rate, Verizon might figure out how to build a 5G data center on a stranded oil tanker before the blockade lifts.
Oh, man.
I mean, seriously, if your portfolio ended in the green today, congratulations, you are moving faster than the global supply chain.
That is a painfully accurate assessment of the physical reality versus the digital tape, Daniel.
Yeah. So what should we be watching next?
Well, for the listener mapping out the rest of the week, the next 24 hours are incredibly dense with new data.
Right. On Tuesday at 10 a.m. Eastern Time, we get the Conference Board consumer confidence data, which will give us a really solid read on how the domestic consumer is handling this inflationary pressure.
We also have a very heavy earnings slate to navigate. UPS reports early at 6 a.m. Eastern Time.
Well, UPS, always a good logistical bellwether.
Exactly. Then Coca-Cola reports before the opening bell, which is always a great indicator for global consumer pricing power. And S&P Global holds its earnings call at 8:30 a.m. Eastern Time.
So a busy morning. But the main event taking up all the oxygen in the room is happening in Washington, right?
It absolutely is. The crucial event for global markets kicks off Tuesday at 2 p.m. Eastern Time when the FOMC begins its two-day policy meeting.
Right, which sets the entire stage for Federal Reserve Chair Jerome Powell's press conference on Wednesday.
And he is walking into that press room right in the middle of a looming, highly politicized succession fight involving Kevin Warsh. The market desperately needs to know if the Fed's reaction function is going to remain independent of the political chaos surrounding it.
It really is going to require immense precision from the Federal Reserve to navigate that press conference without spooking the bond market.
It will. And as we wrap up today's deep dive, I want to leave you with one final provocative thought to mull over as you digest everything we unpacked today.
What's that?
Well, we are seeing Microsoft actively ending its revenue share with OpenAI to protect its own profit margins. At the same time, we are seeing legacy telecom giants like Verizon scrambling to retrofit their existing fiber networks just to grab a piece of the AI capital expenditure pie.
Right.
So the question is, are we quietly shifting away from the rapid open wallet infrastructure building phase of the AI boom and moving directly into the ruthless margin squeezing phase?
That's an interesting framing.
Right. And if the software giants are shifting their focus to cost control, what exactly does that mean for the sky-high valuations of the chipmakers once these companies stop subsidizing compute power at all costs?
That is a fascinating dynamic to watch in the coming months. Well, that is all the time we have for today. Let us know your thoughts on today's market moves down in the comments.